Welcome to the Tricio webinar. My name is James Chu. I'm the head of investment solution at Tricio. Joining us today is our chief economist, John Calverley, and our chief strategist, Jerry Salaya.
Okay, so China, the short-term challenges first, and then I'll talk about the long-term challenges. Energy shortages, you probably read about that. China's been having serious issues over the summer with lack of energy, which has forced them to close factories and also had blackouts. And that's one of the reasons why GDP in the third quarter was very weak. It only rose 0.2% quarter on quarter in the third quarter. And a lot of it was to do with the energy shortages. It was also, especially earlier in the quarter, due to COVID closures of ports and of some factories. And the issue, I think, with energy is going to be dealt with fairly quickly. The government's already reversed course on that. They've already decided to use coal again. They were trying to cut it back, but they've reversed that policy. And they're now pushing ahead. So they do have problems with drought that have affected the hydroelectric and also problems with some coal mines where there's been floods. But I think they will solve those problems over the next few months. The issue with COVID is perhaps a bit longer term. Just about every country now is going for the endemic approach, where you accept that COVID is going to be endemic and you try to use vaccinations to protect the most vulnerable people. Australia, New Zealand, Singapore have all gone that route over the last few months. But China is still going for eradication. And they're doing a pretty good job so far, but whether that's really sustainable over the long run, I rather doubt. The trouble for China, though, is that the vaccines they've been using so far are probably less effective than the Western vaccines. They are developing an mRNA vaccine, and hopefully they will have that over the next few months. But until then, the eradication policy means that, first of all, they're likely to stay very close to the rest of the world, and that doesn't help with economic growth. But also they're likely to have to use local lockdowns periodically to deal with outbursts of disease. So in the long run, I think that's not going to be sustainable, and it could cause problems over the short term. The third issue is the house building slump that we're seeing now because of the Evergrande crisis, and I'll talk more about that as we go along. The long-term challenges, well, declining productivity growth, and I'll talk about that in a moment. Excessive debt, again, I'll talk about that. People have been discussing that for some time, and it continues to get worse. Overinvestment, well, again, this has been something that's been talked about in China for years, and they've continued to invest heavily, and I think it is really a serious problem. Fiscal strains, you don't hear this one so much. Quite a lot of people seem to assume that the government statistics on budgets, on budget deficit are a fair case. Actually, the budget deficit is much higher than they suggest, and they have much less room for maneuver than they appear to have. So I'll talk about that. And then finally, the so-called common prosperity approach that Xi Jinping has been talking about for the last few weeks. That now seems to have come forward and entirely usurped any market reform agenda. And I'll talk about that as well. So if we look at the path of GDP growth in China over the long run, this is going back to the 1990s, you see the very fast rise in the 80s and early 90s. Growth slowed, then it picked up again in the early 2000s, and that was very much due to the World Trade Organization and massive export growth. Then we had the global financial crisis. Since then, GDP growth has been gradually slowing, and before COVID, it was down to about 6%. Now that's still pretty good, but those are the official numbers. And although many people are reluctant to put a number on it, either because they don't want to upset the Chinese authorities or because they're not sure, a lot of people privately will say, well, actually, growth was never 6 and 7% in the last 2 or 3 years before COVID. It was lower already, perhaps in the 3 to 5% range. So growth has been slowing for a long time now. And one of the reasons for that is that the total factor productivity growth has slowed. Total factor productivity is the productivity you get after including all the investments and all the labor that's applied to the economy. So it's that extra bit that comes from increased efficiency, if you like. And that's gone in waves. There was a big wave after the opening in 1978. Then there was another wave in the late 1990s after the state enterprises were reformed. And then the biggest wave really was the WTO wave in the early 2000s. But you can see that has now entirely faded. This chart goes to 2019, and already we'd come to zero on total factor productivity. So now, in order to get growth, they need to have high investment and other resources applied. There's been three phases of growth in the 21st century. The first part was the export-led part that I talked about as a result of joining the WTO. And China hasn't been export-led now for at least 10 years, but it was important in the early 2000s. It was really replaced after that by investment and also building up debt. And I'll show you some stats on that in a moment. What they're attempting to do now is to transition to consumption-led growth. That's going slowly, I would say. COVID obviously hasn't helped because people have been cautious, they've been at home. But also consumers still want to save. There's still a lot of uncertainty in the way China operates. There's very little in the way of pensions, and people only have one child to look after them normally. Also, sometimes people are saving for a house, which they see as the best long-term investment. So household savings are still rather high, but business saves a lot too. And one of the reasons is they don't pay very much in dividends. This is something that's been talked about for years, but somehow politically it seems very difficult to change. So the state-owned enterprises, the central state-owned enterprises, pay just under 3% of profits in dividends, which is very low, obviously, compared to Western standards. So I mentioned the export-led strategy is played out, and part of the reason for that is just that exports from China are already so large in the world economy. But it's also partly about wages. So back in 2000, you could hire 30 people in China for one person in the US. Now it's 5, and it's changing all the time. So there's still an attraction to it, but it's much less. I think the reason that people source from China is not really because of low wages anymore. It's because of the efficiency of the operation there, generally the supply chains, the wealth of companies producing all kinds of goods. That's why people invest in China, and that's why they source from China. So wages are not really the story anymore. Let me turn to the property side. This is the Evergrande stock price. It collapsed, as you can see. The market opened again just today, and the price fell again, about 14%. And what's been going on really is a sort of a confidence crisis about Evergrande's ability to continue, and that's affected its liquidity. So developers rely on pre-sales of flats and also bonds primarily to finance land purchases and construction. And then in August 2020, the government brought in its 3 red lines policy, trying to reduce developers' fragility. So they put on limits to the 3 debt ratios: the liquidity to assets ratio, the net gearing ratio, and the cash to short-term debt ratio. And calculations soon after this was announced showed that very few firms could meet all 3 of these. And if they didn't meet them, then they wouldn't be able to borrow as much in future from banks. So this put a lot of pressure on the developers. They tried to deal with it. They tried to deleverage. But what we saw over the last few months is it led to a confidence crisis because people started to believe that it was dangerous to put a deposit down with Evergrande to build a new flat. Because you might get locked up, you might not even get it back, might be a bankruptcy. Even if you think you might get the money back in the long run, you don't want it locked up. So suddenly they didn't want to put money down to Evergrande, and then they didn't have the money to actually pursue building. They couldn't pay their suppliers, and also, of course, they couldn't meet some of those ratios, particularly the cash ratio. So they got into basically big trouble. They haven't officially defaulted yet on those bonds. I think it's next Monday is when they will officially default. The news today was that one asset sale hasn't gone through, so it looks like they will default. I think what's likely to happen here is that Evergrande as a company will go down. That the central government has been pretty clear that's what they want to see. I think they'll do that as an example. I don't think they'll allow a financial crisis, and there's a number of reasons for that. One is that banks are not very exposed anyway. As I said before, much of the financing comes from pre-sales and also from bonds, and some from shadow banking. To the extent that banks are involved, they tend to be secured, so they're not particularly exposed. And also the government can generally provide support to the financial system. The issue is not so much a sort of financial panic, it's more a building panic, as I mentioned, that people don't want to give deposits to builders, to developers. And that's not just true for Evergrande at the moment, it's true for quite a number of different developers. So I think the government at some point is going to have to come in and stabilize that. They don't want a collapse in house building because it's such a big part of the economy. I think they do want it to slow down because there's been too many houses built and the population is no longer growing. But nevertheless, they don't want it to collapse because that would really impact GDP. On the widest measure, it accounts for 29% of GDP. That's taking into account all the inputs that go into it. So to the extent that you get a housing slowdown, that points to an economic slowdown. This chart goes up to 2019. So you can see that house building was already slowing. Back in the first part of the 2000s, it was running at about 20% growth year on year. Now, if you think that you've got 20% growth in a sector that's 20% of the economy, that gives you 4% of GDP growth straight up. So house building was hugely important throughout this period. It's gone down pre-COVID to only maybe 5% growth. Still, at 29% of GDP, that gives you a pretty decent boost. But this is likely to go negative now. So you've got something like 29% of GDP, which is declining. You've got to get your growth out of the other 71%. So that's quite hard. That really points to a significant economic slowdown. And if house building is slowing, jobs in that area are going, businesses that supply are slowing, that's going to affect all kinds of things. So let me turn to the longer term issues that lie behind this. Over indebtedness. This is a chart of total non-financial debt in red, and if we exclude the government in blue, you can see it was rising in the 90s, but then stabilized in the 2000s. Actually, China had really its golden years of growth in that period. So debt was rising, but so was GDP, and the ratio was basically pretty stable. Then along came the global financial crisis, and the government used debt to boost the economy. They managed to pull that back, as you can see, around 2012. But then after that, debt continued to rise. And the economic growth that we saw in the 2010s, even though it was declining, as I showed earlier, it was only possible because you did have this continuous rise in debt. So it was really a debt-financed expansion, which is not terribly healthy. And these levels of debt are now relatively high. If we break it down, you can see government debt in the last 6 years has risen to over 80% of GDP. Now you'll see different figures for government debt. This is including local government. 80% of GDP is a level I would say that you don't really want to raise that too much more in an emerging country. It's not a crisis level, but it's certainly a level which makes you think let's not increase debt too much. If you look at non-financial corporate debt, that hasn't risen much since 2014, but it was already high. Actually, that level over 100% of GDP in 2014 was already considered very high. And the other big change is household debt has increased. Go back 6 years and household debt was really not that large, but now it's around 60% of GDP. And bearing in mind that household incomes are about 60% of GDP, that means that debt to incomes is about 100%, which is pretty high for an emerging country. So across the board, really, with these debt ratios, they're at levels which the government doesn't want to increase very much more. Now that debt went to finance investment. This is the ratio of investment to GDP. So you can see back in the 80s and 90s, it was oscillating around 35 to 40%. That was already considered very high. If you look at the other East Asian countries like Japan, Korea, Taiwan, they tended to invest around 30% of GDP. So China was already investing more. And then it went up even higher in the 2010s, up to 45% of GDP or so. And that level of investment, as I showed, GDP growth was actually slowing. So obviously investment was becoming less effective. But it was also I think, excessive investment. And you see that when you visit China, the level of the infrastructure is extraordinary for an emerging country. No other emerging country has anything like the quality of infrastructure. And of course, that's helped them a lot with economic growth. Nevertheless, it also seems pretty clear that they've built ahead of what they need. And that's true in infrastructure and in housing and in other areas as well. So they've got excess capacity. I talked about the government debt. The other area that people don't talk about much is the deficits. Now, quite often you'll see a figure of around 3% for the government's deficit. That's a narrow measure of the central government deficit. When you include local governments, you can get to about 6% of GDP. And if you actually include land sales as well, then you get to around 12, 13% of GDP. These are IMF numbers. So these are levels which, again, I think the government doesn't really want the deficit to expand. A deficit of 5 or 6% of GDP is not a disaster if you're growing strongly. Becomes more doubtful whether that's healthy as the economy slows down. And as I say, when you include the local government and the land sales especially, you really do have very high government deficit. So the economy has slowed, and I think a lot of people are expecting them to do some new fiscal spending next year to deal with the slowdown. I'm not sure they're going to move very rapidly on this, but I think they probably will try to do something. But they've got a problem because I mentioned those land sales. In 2020, land sales generated revenues of 10% of GDP for local governments. And at the moment, developers are cash strapped. They've got to try to meet those 3 red lines. They're not getting as many pre-sales. So it's going to be hard for them to find the money to buy more land. So that's almost certainly going to slow down. It is widely expected that they'll announce a property tax. They've already been experimenting with it in various provinces. It's likely to be set fairly low, at least to start with, though, so it won't nearly cover that 10%. We're also seeing changing budget priorities, I think. They want to raise taxes on the better off, although taxes in China, certainly on salaried people, are not low at the moment. I think they want to tax the entrepreneurs better. But they also want to increase welfare spending, especially pensions and so on. And then there is a military buildup going on. The US, Japan, Taiwan, and China is basically trying to increase its power in that region. So they want to spend more on the military. So they have, I think, considerable fiscal strains that you don't often hear much about, but I think that does affect their thinking. So in terms of policy, I mentioned that free market reform is now a low priority. I think to understand China, it's important to remember that this isn't a country which was sort of successfully developed by a highly efficient central party. What happened was the central party got out of the way. There was a series of market opening measures where they freed up prices, freed up wages, freed up firms, restructured the state enterprises so they didn't get in the way so much. That was what drove Chinese growth until now. But free market reform now is really quite a low priority. There are still some attempts to do it. The central bank is still pushing in some areas, but it's not really what they're trying to do. Party control is central, and then industrial policy. The aim is to have strategic dominance of key industries. The so-called Made in China 2020 strategy, which I guess is now about 5 years old, and they've got about 10 high-tech manufacturing areas where they really want to dominate the world, and they're subsidizing and investing heavily in those areas. And then common prosperity, I mentioned earlier. This is something that Xi Jinping has been talking about, particularly the last few weeks. And it's really redistribution and intervention policies across a wide range of areas. For example, the controls we've seen on the education industry, on the gaming industry, video gaming, and also on the gambling sectors, Macau, for example. So I'm talking about a China slowdown because of all these issues. Is that a good thing or a bad thing? Actually, as long as it's a modest slowdown, I think it's probably quite a good thing. It's certainly not a particularly bad thing for the West, at least, because I think it points to lower world inflation, which is obviously an issue at the moment. China, by the way, doesn't have an inflation problem at the moment. I didn't mention it because they don't have a problem. And I think to the extent that China itself slows down, that will reduce the pressure on commodity prices, on energy prices, and will probably help the West. And that points to lower interest rates as well. In the West, less of a need to tighten policy. So that's also good. We may see China easing monetary policy as well, possibly allowing a lower renminbi. It's been rising in recent year or so. I think the China slowdown then is going to be good for growth generally in the West because of lower interest rates and lower inflation, and also good for stock market valuations. Not so good for some of the other emerging markets who rely quite heavily on supplying China with commodities and such like. That's if it's a moderate world slowdown. I think there's still some danger of a so-called China crisis. Over the last 25 years, it seems like there's a succession of crises. We're usually talking about one crisis for a couple of years, and then we have a break for a few years, and then we get to the next crisis, whether it's the Asian crisis or the technology crisis in 2000 or the global financial crisis or the euro crisis. And now we're still, I guess, in the COVID crisis. What's the next one going to be? Well, it could be a China crisis where China doesn't just slow down, but really slumps and gets into deep trouble. And I have to say, I think we will kick ourselves if that does happen, because I think the warning signs are there. The reason that I don't think it'll happen, and the reason that most people don't think it'll happen, is that the government is so focused on stability, and it has so many levers that it can use to manage the financial system, to manage expectations, to push in more investment if the economy looks like slowing. So that's why we all tend to think that it won't happen. But don't rule that out. I think it's a risk scenario, but I wouldn't rule it out. I think we're also going to see a continuing divergence between the US and China. The new president in the US, I think, has basically followed the same policies as Trump, only more effectively. We haven't seen a change in trade policy, really. And on strategic policy, Biden has been much more successful in bringing allies on board to essentially encircle China, the way they would see it. So the move towards divergence, which is sort of beginning, but I don't know how far it's really gone yet. A lot of companies are still very involved with China. The economies themselves are very intertwined. This is going to be a difficult area over the next few years, and certainly one to watch. So what does all this mean for investors, and how you should think about investors? Well, let's first of all think about investing directly in China's stock markets. And I put here some pros and cons. Certainly the Chinese market is cheaper than the US. I'll show a slide in a minute on the tech side, and it's very clear there, I think. There's the argument that it's a good diversifier. Obviously, to the extent that the economies diverge, it could become an even better diversifier. It is still faster growing than the West. If it slows down to 3%, which will be pretty low, but that's still better than the West, which is growing at 2% at most. What about the cons? Well, this long-term economic slowdown, I think, doesn't help. I mean, the relationship between stock markets and economic growth is by no means straightforward. But nevertheless, an economic slowdown generally doesn't help. Then there's the government policy uncertainty. We've seen a series of announcements this year which have upset particular industries, whether it's the tech industry, the education industry, and so on. So I think we may see more of those, and certainly that builds a level of uncertainty into stock valuation. And then there's issues on the ESG side. On the environment side, China is a heavy polluter, and it's now gone back to coal. It's still building coal-fired power stations in China. So there's a concern there. There's human rights concerns with Hong Kong, with Uyghurs, with Tibet, and so on. There's also corporate governance concerns with Chinese stocks. The party is still very involved. The ability for minority and foreign shareholders to enforce things in China is tricky. So there's certainly some people who say that China is now uninvestable for these reasons. I think this is definitely something to bear in mind. If we look at the performance, the blue line here is Shanghai. You can see it's very volatile. I had a couple of bubbles and busts in the last 20 years or so. It's actually gone up less than the US, although more than the UK. Well, that's not saying much, but the UK is not much. And certainly in recent years, the US has done considerably better than China, as you can see. And if you look at tech stocks, what I've done here, or rather what Jerry has done for me, is dig out a couple of ETFs. So the red one is the XLK, which is the US technology stocks. And the blue one is China technology internet stocks. And you can see there the US stocks, of course, just trending up, and particularly in the last couple of years. China had a lift in 2020 and collapsed this year because of those policy changes that I talked about earlier. So certainly US tech has done a lot better than China tech. When it comes to looking at the valuations of the market itself, I mean, we tend to look at the cyclically adjusted price earnings ratio. It's a little tricky for China, but nevertheless, if you look at the position now compared with the last 15, 20 years, you can see that although it's come down, obviously, with the slump in the market this year, it's not particularly cheap at the moment compared to other periods. And we view this as a fair valuation rather than a cheap valuation. So those people who say you should go in and load up on China, I'm not sure that this supports that. I think it suggests that China is fairly valued. The US, we think, is highly valued, but not particularly cheap. The other issue to watch out for, of course, for many investors is that if you own ETFs or funds in the West, chances are they do have exposure to China. So, for example, the MSCI Emerging Market Index has 33% in China. So any ETF or fund linked to that is going to be quite heavily for China. I've also put the numbers for Taiwan and Korea. Of course, they're somewhat influenced by what goes on in China, so a big slowdown in China would impact those countries as well, although they've also got other things going on as well. And then some popular funds have big weightings. The Scottish Mutual Trust, for example, in 2020 at least, I'm not sure what the latest number is, had 22% exposure in China. So it's difficult to be completely out of China because of these weightings, particularly in emerging markets, to some extent in the tech side. The other way that China directly impacts on stock investments in the West is that many companies do actually rely quite a bit on China, business in China. So up to 25% of US companies' revenues in ETFs are derived from sales in China. This is something from the FT. And if you look at the FTSE, there's significant China exposure. The chart on the right shows AstraZeneca. The yellow slice of the pie is China's revenue. You can see that just under a quarter. That will be true of quite a lot of companies. So if we see a slowdown in China, that's going to impact a number of companies. And in Europe, you've got the luxury shares, you've got the German capital goods companies. So there's quite a widespread exposure among specific companies. So what we're saying to clients is you need to consider the effect of the slowdown of China on particular companies as you go through your investments. So I've talked a lot. Let me summarize. China is slowing down. That, I think, is widely held, that view, but it may be slowing down more than people realize. There's some risk of a real slump, but more likely they will keep growth going with the levers they've got. It's not just the most recent things that we've heard about, the energy problems. It is a long-term thing related to productivity, related to overinvestment, and of course the property slump. We don't think fiscal policy has all that much scope. They may try to do some next year, but they won't be able to, or they won't want to massively rescue the economy with big new infrastructure spend. The slowdown is probably okay for the Western economies broadly. It actually eases some of the worries about inflation, probably means the Fed, the other countries will not feel quite such an urgent need to raise interest rates. It's bad for some emerging markets that rely a lot on exports of raw materials. Many investors in practice are exposed to China stocks via funds, even if they haven't got a China fund. An emerging market fund many other funds and investments are exposed to China stocks, so be aware of that. Many Western companies are exposed to a China slowdown as well, particularly Germany, luxury in Europe, and so on. I think, as a sort of bottom line, I think the view we have at Tricio is that we don't find China particularly attractive. We tend to underweight it in our portfolios. And this is for all the reasons I've expressed, really, and not least the corporate governance issues, which I think are a particular worry for us. Okay, that's it. Thank you very much.